Hi, everybody. Welcome to the February 2024 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. January was in general a good month. Markets were mostly flat to up, with the U.S. stock market doing best with gains in the lower single digits. Fixed income did less well on volatility and interest rates, and international markets also lagged, with emerging markets doing worst of all. Not a standout month like December, but not bad either, considering everything else going on. The mixed results came from mixed data. The economy continued to do well. Fourth quarter growth was reported as 3.3%, well above expectations, driven by strong retail sales. Those strong sales, in turn, were supported by very strong job growth and rising consumer confidence. The consumer economy continues to go from strength to strength. And once more, we simply don't see any recession in the data. That strong growth, though, kept inflation steady, meaning we're not seeing the continued decline that's been hoped for. Headline inflation actually ticked up a bit last month, and while core continues to decline slowly, the improvement is simply not enough for the Fed to declare victory. In fact, in yesterday's press conference after the regular Fed meeting, Chair Powell disappointed markets by signaling there would not be a rate cut at the next meeting, sending the markets down for the day. And that disconnect between what markets expect and what the Fed is likely to do drove the interest rate volatility we saw during the month. And that's also going to be the question for February. What are interest rates going to do? Because beyond the Fed itself, we need to watch things like the effects of the war in the Middle East on supply chains, which could push inflation back up. We need to watch the pending election, which is going to increase uncertainty across the board. And of course, there are many things we don't even see yet. There are very real risks out there. But despite all that, the big picture says we're still in a very good place. With the U.S. economy sound, especially on the jobs front, the foundation is solid. Corporate earnings came in better than expected last quarter and should keep growing. So despite the market's reaction to the Fed's most recent press conference, the fact remains that the Fed did acknowledge that we're getting closer to normal, and that's a good thing. And for markets, after a very strong year like 2023, the momentum tends to continue. So on the whole, we're still in a good place as we move into the new year, and I do expect that to continue, at least for a while. Thanks for watching, and I'll be back next month to talk with you again. Until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And have a great month.